The S&P regional banking sector has been under pressure this year. Volatility is to be expected in banks with these wavering hopes for Fed rate cuts this year. What's the outlook for regional banks if rates stay higher than had been assumed? We're joined now by somebody who tracks this sector minutely, very closely. Chris Marinac, Director of Research and Analyst at Janney Montgomery Scott. Thanks very much for coming on the show.
Sure.
Before we get into rates, I mean, is there any other reason why the regional banks would have underperformed this year?
I think credit quality is really everyone's concern. The idea is that charge-offs and problem loans are going to rise from commercial real estate, that we have some type of commercial business lending slowdown this year, a recession in the offing. All of that is weighed on banks this year. I think to some extent the fears are a little overdone, but I think credit concerns have definitely been a factor.
And because as far as I know, the regional banks, or some of them, as a percentage of their book, they're quite exposed to commercial real estate.
That is correct. And the major exposure tends to be in multifamily. There is office exposure, but most banks tend to be in the 3 to 5% of their book in office. It's a much bigger exposure in multifamily and retail and even in industrial properties.
That's interesting. Multifamily. What would the lenders be? Who are the borrowers? Are they big national companies? Or are they mom and pops or regional companies? Who builds multifamily units?
It tends to be public REITs. It tends to be local private developers. There are some mom and pops, but a lot of it has to do with kind of, I would say, more regional players in the multifamily space. A lot of this is simply a supply and demand issue. Multifamily is generally still pretty solid. You just have some supply issues where there's excess supplies in places like Austin, Nashville, even Atlanta, but those markets tend to be temporarily oversupplied. The demographics are still really strong, and it tends to work itself out.
That's interesting, temporary oversupply. I mean, Atlanta is meant to be booming right now, and I think you said Austin as well. That's had an incredible growth.
Correct.
Tell us, what about the impact on the regional banks if interest rates don't get cut at all this year, to adopt a drastic scenario?
So most of these companies are all-weather companies. They can raise rates on their loan yields to offset the higher deposit costs. They simply will make more money if interest rates were to crest and go lower because of the cost of funds having surged so much. I think overall loan demand is really tepid right now, and it seems to be getting slower as the prospect for higher for longer is tapping loan demand. If we saw a Fed rate cut late this year, next year, I think it would engender more demand in loans. It would actually create more flow through to the business. So it would be very healthy. But I think right now we can stomach the business still plodding along, making a reasonable return, just not having the level of growth or the level of profitability if rates stay high.
We did get earnings from one lender today, Truist. Their profit was under pressure because they had to pay customers more for deposits because rates have stayed stable. The Fed hasn't cut. What is your feeling on Truist? Is it a stock you'd buy right now?
Well, Truist is a neutral rated for us, but we like the company in terms of how they're positioned. They made a strategic move to sell their insurance business to improve capital. They're now going to redeploy those proceeds into higher interest rates and bonds. And I think you'll see them actually have a better earnings profile the second half of the year as those proceeds are put to work. The company, I think, has a ring fence around the credit issues they have. They have a relatively high guide on net charge-offs, and their current earnings can actually absorb all these net charge-offs. So I actually feel that they're handling their own issues fairly well, and that you'll see them have better results the latter part of the year.
After the failure of Silicon Valley Bank or near failure and Signature, is there something of a hair trigger on the regional banks? Are people nervous? Are they prone to selling if they get scares in the sector?
Sure. I mean, we saw the New York Community event this year in late January through February. That was a good example of everyone getting nervous very quickly. I think liquidity is key in the banks. So many companies have excellent liquidity today. Between the Fed, the bank's own securities portfolio, the access to other funds through the home loan bank system, the banks are in very good shape for liquidity. It's just convincing the marketplace that they can handle these scares when they occur. New York Community had good liquidity too. It just the perception became very ugly for about 2 to 3 weeks, and that led to a miniature crisis on the deposits for a few days.
On at New York Community Bank Corp. Yeah, I'm just looking. I'm not sure if we can put up the chart, but that was interesting. Okay, they were in the headlines for unpleasant reasons for a while. I see the stock did drop, and it hasn't got back to its former levels, NYCB.
Sure. I think NYCB has to report earnings this week, next week for Q1. They have a new leadership team. They have a lot of one-time charges and noise they have to get through, but the company has the capital to reposition themselves. And I think you'll see this company does a lot better than folks realize. The ultimate credit quality of NYCB is going to prove to be better than it's understood. But it is a new leadership team. They have new folks that have to kind of get in the driver's seat and really position the company to be a much more well-rounded bank. So it'll take 3 or 4 quarters to really get it honed to where they want it. But I do think you'll see better results from the company.